Alright, today is Monday, October 19, and this is a post-market review for the stock market activities today. Before we start, let me thank everybody who subscribed to the channel, pressing the like button, and making comments on the videos. I read and I like all the comments, so keep doing that. We do have important subjects to discuss today. Of course, the market had a big red day, so we'll talk about that. I'll give you, of course, an update about the whole stimulus thing and some news from the Federal Reserve. We have some company-specific news as well. And then we have interesting options trades and the charts per usual, but we're also including the chart of DraftKings this time around. And here we go. The Dow Industrial Average in the red by 410.89 points, or a decline of 1.44%. The Nasdaq in the red as well, 192.67 points, or a decline of 1.65%. The S&P 500 in the red, 56.89 points, or a decline of 1.63%. A decline across all the indices. Moving on to the sector's performance, and as you can see, every sector managed to close in the red. No medals will be given today, but leading all the decliners, of course, utilities, energy, and financials. And the laggards of the day were real estate, communication services, and healthcare. Moving on to the futures market performance. Right away in softs, you see lumber making a comeback. So did coca. These two futures of lumber and coca been lagging for a while, and you saw a big bounce today. Sugar, cotton, OJ, all in the green. Coffee is the notable decliner. What's going on with metals? Copper in the green, which is very baffling right now. You see the stock market down, the dollar index down, copper up, gold, oil muted. Meanwhile, treasuries are up. Treasury yields, that is. So we're still in the divergences and the confusion, and all of that will be sorted out very soon. If you remember, in 2018, we had a similar scenario, and all of that was resolved in a big market correction. So we'll see if this is what we're facing this time around. But here we go. Platinum lagging in metals. What about meats? You see milk and lean hogs leading the day. However, not so shabby for live and feeder cattle. What about grains? You see soybean meal having a good day along with canola and oats. Soybean oil is the notable decliner here. It had a pretty good beginning of the month, and now it is giving some of those gains away as, of course, newer contracts open. Moving on to the big casino, the options market. What do we see here? Apple leading the day per usual by 1.47 million contracts. 68% of those were calls. NIO at number 2, 526,000 contracts. 67% of those were calls. Tesla at number 3, 483,000 contracts. Again, 67% of those were calls. Which trade was the volume leader today? It was Apple, the 120 call expiring this week. Now, depending on when did the buyers of this trade conducted the trade would determine whether they're underwater already. If they bought at the beginning of the day, the trade is probably already in the red. If they bought just a little bit before the closing bell, maybe there is a chance for this trade to work again. But it is notable that Apple broke the 120 support, and it will be very hard to climb right back. Moving on to the change in open interest, and what do we see here in the increase of open interest? We did see a lot of bullish activities for Microsoft buying the 250 and the 230 calls expiring in December. And of course, the stock of Microsoft is not trading anywhere near these numbers, so it is a bold, big bet. We will see if these traders are correct or not. We also see the Tesla 120 put expiring in January. So somebody's betting on a big decline here for Tesla, perhaps just to catch some time value from the trade and then close it at a profit. Of course, it will take pretty much a disaster to move Tesla all the way back to 120 by January. And we also saw more bullish activities for Pfizer, buying the 39 calls expiring in November. What's going on with the decline in open interest? We see right away profit taking in names like General Electric, NEO. They're closing the calls that they've been buying and opening the last 2 weeks. So don't be surprised if you see General Electric and NEO trading in the red this week as these traders close their bets, taking profits off the table. We see the same thing with ExxonMobil. They're closing the puts this time around. They're closing the bearish bets against Exxon, taking chips off the table and perhaps paving a way for Exxon to make a recovery here. Of course, all of this will be dependent on the overall market. If we decide to sell off due to a stimulus failure, then everything would go down. However, we're seeing an intense activities of bullish trades for ExxonMobil. And now let's check on some interesting trades that we found throughout the day, and there was a lot of them. It is the same theme here with Microsoft. They're buying the 235 calls expiring in November 6. So perhaps there is something here going on with Microsoft, some pending news, and we're seeing insider activities here being very, very bullish. But here is a bearish trade for Hilton, buying the 80 puts expiring November 20th. Very interesting. And you see, of course, Fastly buying the 70 bucks put, so they're betting on further pain for Fastly here. And this trade, of course, is expiring October 30th. And here is another trade that was done today for IBM. They bought the 119 put expiring this week, and you see IBM reported earnings after the bell. The stock, last time I checked, is declining, so this trade is probably very profitable right now. Moreover, we see the theme of betting in upcoming earnings here for Las Vegas Sands. They're bullish, buying the 48 calls expiring November 20th. The stock will report on Wednesday. However, they're giving themselves a little bit of time here for the trade to work, just in case you see Las Vegas Sands dropping after the report. What about Coca-Cola? Again, buying the 46 puts here, bidding on a downside for Coke, and this trade is expiring this week. Here is another interesting trade for Kroger, a name that I own in my portfolio. Buying the 39 calls, so big upside here for this trade, and this is expiring in December. Perhaps this is a bit on a resurgence of coronavirus, or of course, as I've discussed before in my analysis for Kroger stock, remains a winner regardless of the coronavirus environment. And the last interesting trade of the day for FCX Freeport McMoran. This is a copper miner, of course. They are buying the 15 bucks put expiring October 30th. So if we assume that this is a bearish trade on copper, so are they saying that the dollar index will pop? Very interesting. And you have to look at these trades outside of the box. And now, let's move on to cover some headlines that shaped the day. Right away, let me update you about the stimulus fiasco that we have, the circus that has been going on for weeks now, keeping everybody on edge with no results whatsoever, dragging the talks about the talks, about the talks, about the talks, until all your options expire worthless, and then of course they'll make a final decision. But here it is, right away in the morning we saw treasury yields climbing higher on quote-unquote stimulus optimism. However, as we progressed through the day, you saw that optimism fading out and the market declined and managed to close severely in the red. Of course, we've heard from the White House spokesperson, and they said that they are quote-unquote cautiously optimistic, whatever the hell that means. And then right away, we've heard another update that the White House decided to up the offer to all the way to 1.9 trillion bucks. And then we've heard that Mnuchin and Nancy will have another phone call so they can talk about the talks yet again. Now they've already upped the offer to 1.9. So what is the sticking point here? And of course it turns out that the sticking point is the language. They're debating the language of the deal. How about we do it in English, but with a British accent? Maybe we can fool Americans into thinking that this is a good deal for their future, racking up another 2 trillion bucks in debt for the future generations to deal with. And of course, we do have updates from the Fed, our favorite subject here, and we're hearing from them saying that it will be very, very difficult for the Fed to break up the relationship and the engagement between the Fed as a supplier of monetary policy and the government and the markets. So this is what happens when you create a Coke addict market. When we talk about Coke, we're talking about the Fed's liquidity. The Fed, of course, is the Pablo Escobar of liquidity, and it created an addicted market, an addicted government to free fake cash that gets printed out of thin air. And the Fed is saying basically that we cannot break up with this relationship because the government will not be able to function anymore and the markets will crash and throw a fit, just like a drug addict would in a withdrawal period when you take the drug out of their hands. And to shed more color on the subject, we have Fed chairman, or vice chairman rather, Clarida, saying that continuous support from the Fed, the monetary policy, and the federal government, the fiscal policy, is needed to continue to support the economy. So there is no exit strategy here. The Fed knows that the government is broke and they cannot raise taxes enough to cover for their spending. So they need the Fed to continue to buy treasuries, print the fake money, buy treasuries, and fund the government. And there is no end in sight for this operation, the cocaine operation. And read the market, there is no end in sight too, because anytime the Fed would decide to increase interest rates to stabilize the economy in case of an inflation, or if they decide to step down the liquidity operation, aka the cocaine operation, the market would crash, will throw a fit, and will probably never ever reach the highs from which it crashed. And that will leave millions of people underwater in their retirement accounts. Furthermore, Clarida is pretty much saying that we're going to have prolonged unemployment for the foreseeable future. And whether you like it or not, we're going to have the Andrew Yang thing of a universal basic income, at least for the unemployed, meaning that the government would need to borrow more and more and more and more to sustain this zombie economy. And perhaps this is the funniest piece of news we've heard in a while. The Federal Reserve is now worried about creating an asset bubble. Speaking of the bubble, we do have Morgan Stanley now saying that the market will plunge over 10% very soon. And they gave this chart, they provided this chart showing some technical analysis combined with the elections that we are about to have. And they're saying 10% is the number here for the plunge or the correction that we're going to have pre or post election. We always have one or the other, and it's starting to look likely that we're going to have a pre-election crash, and maybe we'll have a cherry on top, and we get another one after the elections too. Because, and here's another piece of news, the media and Wall Street are finally waking up to what we've been saying on this channel for a very long time now, that the market has been invaded and controlled right now by the Robin Hoodiots. Who are the Robin Hoodiots, by the way? The Robin Hoodiots is a generation of investors who invaded the market in the 2016 era, but specifically during March of this year. They saw the plunge, their eyes lit green, they downloaded Robinhood or whatever app they use. They figured out how to press a couple of buttons like it's a video game. You buy calls, you put your blindfold on, you buy calls randomly, and you ask questions later. Matter of fact, you don't ask questions. You go Naruto style, diving in heads first toward the danger, buying stocks, all kinds, buying calls out of the money, expiring in the same week. Doesn't matter, because the Robin Hoodiots motto is stonks only go up, and there are no red days. And if there are red days, there are opportunity to buy. And of course, with that kind of philosophy, we've seen a replica of the Robin Hoodiots, or actually the Robin Hoodiots are the replica of the dot-com bros in 1999, who also believed that stocks only go up and you don't need revenue, no profits, you don't even need employees or offices for the company to be worth billions of dollars. You don't even need the company to exist. And of course, we saw a ton of fraud during the dot-com bubble. And we're seeing a little bit here in our own bubble in 2020. But we all know what happened to the dot-com bros. They lost everything. They had pretty good years, couple of years, bragging to everybody about their quote-unquote gains, buying luxury cars on lease. And what do you know, when the dot-com bubble bursted, they lost everything. All these luxury cars got repossessed, and then they went back to working in McDonald's. And of course, it's the same story repeating itself again, and the Robin Hoodists will face the same outcome, even worse because we are in a pandemic and even the jobs at McDonald's are not available anymore. Thus, young and dumb. And the boomers, of course, are taking advantage of the young and dumb and the boom in the Robin Hoodied gambling, and they're selling their stocks, handing the bag to the Hoodiettes to hold and suffer for years to come. You cannot fix stupid. You can only make money out of that. Moving on to some market-moving news that we had throughout the day, and the first notable piece of news is the number we got from the TSA checkpoints that the passenger level at US airports surpassed 1 million for the first time since the pandemic started. And you saw airline stocks taking off on the heels of this news, that there is a recovery in the airline sector and people are traveling more as, of course, the fears of the virus subside. But it is still not clear here, and I would not buy any airline stock right now, because if we see a resurgence of corona, and we're already seeing it here, and that fear creeps back in, then you will see airlines suffer yet again. And here's another piece of news. Of course, the Trump administration here is very desperate. They're losing in the polls, and the re-election prospects are looking really, really bad. They're not out of the game yet, but it's looking very unlikely as we speak. So what is the solution that Trump think will work for him and help him get re-elected? Is it wearing a mask? Or is not downplaying COVID-19 anymore? Or is it maybe showing some of his humble side? No, not any of that. His plan is to bribe the population and hope that that would work. And we see that the payments for farmers in the Midwest reaching all-time highs. Now, if you're not familiar with the situation here, Trump started a trade war with China, and that hurt the Midwestern farmers here in the United States because they lost their market share. China went on and bought beef and pork and soybeans from Brazil and Russia instead. So the solution for this administration, of course, was to turn this country into Venezuela and start some socialism by bribing the farmers and giving them a paycheck every month instead of giving them their business and their market share back. And of course, the whole deal about the stimulus here is another bribe, that if they sent us a $1,200 check with Trump's name on it, maybe that will persuade some people to vote for him. We'll see about that, but the window is closing. We got a few weeks here to go. The elections will be held on November 3rd. But let's go and move on to the last bit of news that we had today, and it is regarding Intel. Intel is selling its memory chip unit to HK from Korea, and this company is one of the biggest memory chip producers in the world. And this deal, of course, makes sense. Intel need to restructure the business and concentrate on growth and creating more chips for video gaming rather than concentrating on memory, which is a very low margin business. And of course, you saw Intel shares rallying, at least upon hearing the news, but the market flushed down severely in the afternoon and Intel lost most of the gains. So let's take a look here. You see the heat map. Moving on to the heat map, and you see right away Intel and Taiwan managed to close in the green in the chips sector, even though you see the entire heat map as a sea of red. A tsunami of red swarmed the market today, but we do have exceptions here. We talked about Intel and Taiwan. We do have regional banks. Some regional banks had a good day today, due of course to the pop in yields, at least in the morning. And of course we do have Snapchat. Snapchat had a good day. Snapchat is reporting earnings tomorrow. So we saw traders in the options market activities making big bets, bullish bets for Snapchat. We will see if that works or not after the report tomorrow. Zoom, nothing new here. Zoom, the sky's the limit. It keeps going up and up every day until, of course, it crashed. And when it crashed, it'll be very epic. We'll never know when, but it's getting a little ridiculous here for Zoom. Zoom, by the way, is worth more than ExxonMobil right now. It is worth more than any auto manufacturer in the US, exception of Tesla. They're very close at surpassing the valuation of Cisco, the mother company of Zoom. So it is getting a little ridiculous here for Zoom. But we saw the airlines, as we talked in the headlines segment, with the TSA numbers surpassing 1 million for the first time since the COVID-19 crisis. Uber having a bounce today, and we saw some software names like Team and smaller ones having a green day. Other than that, it was pain across the board. Let's illustrate by moving on to the rotation trade. Right away, it is a picture of declines across the board. You see Netflix holding. Netflix, of course, is reporting earnings tomorrow. And traders tried to make bullish bets ahead of time. And you saw Netflix rallying in the morning. However, it gave that up by the closing bell. So there are a lot of traders here in Netflix holding the bag, and they will hold the bag if Netflix crash after earnings. You saw Zoom and Peloton again outperforming. Yet DocuSign, which is supposed to be in that club of the stay-at-home with Zoom and Peloton, not having a good day today. What's going on across the street in the reopening names? Again, it is a picture of pain across the board, but you see a name like Royal Caribbean trading in the green today. Royal Caribbean got whacked severely last week, so perhaps we're seeing the sellers drying out here. You saw a bounce in Royal Caribbean. What about the Cheesecake Factory? The outstanding gainer here, over 4%. But we do have notable declines here in Marriott, over 3% decline. And you have to remember, we saw a bearish trade in the options market regarding Hilton. I do own Marriott in my portfolio, and I bought put options right away after I saw the bearish trade for Hilton. So I do that periodically to protect and ensure my long positions. And now let's move on to cover some charts, starting with the SPY 15 minutes chart. This one went easy. It is a gap and crap. Gapping in the morning, fooling everybody that we will have a big green day. And what do you know? As soon as trading starts, we flush down and we don't stop until the end of the day. But it is very notable that the support levels that I outlaid for you in the last video held pretty well. And for that, let's switch to a 5 minutes chart so I can illustrate for you. Right away, you see from the markings how these levels worked as support, then resistance, and they were to the penny. So when I pick my numbers, I know what I'm doing. Now here's the bad news. The SPY managed to close below all of the support levels we've identified in the last video, which is very bearish. And for now, when we switch to a daily chart, here is the message chart with all the lines that we had before, the support and resistance lines. And as you can see, there are stops on the way here. But let's clean this chart for now. And the first destination we're looking for, if we continue to slide further down, is the gap at around 341. This is a gap that we have not filled yet, and it could add support from that point on. But other than that, all you have to do now is wait and see. We do have some circus activities in the aftermarket regarding stimulus, and they're popping the market again. Who knows if they're going to dump it tomorrow? So you just have to look for the level of 341. And if we break that, then we will start the flood and the tsunami to the downside. However, if we get a bounce tomorrow, the previous support levels now become resistance. So you know where the potential stops for the SPY would take place. Moving on to the Qs, the Nasdaq. 15 minutes perspective. As you can see, we broke the first support we identified in the last video, but we did hold the second support for now, which is notable and important for the Qs. The Qs had a better closing than the SPY here. And again, when we go to a daily chart with all the markings that I have, we do have a lot of support here. We do have a lot of levels to look for. But let's clean it up and let's look for the level of 282.39 for support. This level acted as very good resistance on our way up, and it should work as very good support on our way down. And by the way, what is the point of knowing all the resistance and support levels? The point is here is to know when to close or enter certain trades. It is more beneficial for day traders, but also beneficial for other retail traders to watch. If you have options and you're looking for an exit point, you look, of course, for resistance or support, and that would be your exit point. Now, the last thing I want to discuss from the daily chart of the Qs is the cup and handle formation still intact and still on the table. You know me, I'm skeptical about the cup and handle formation here. We talked a lot about that in the last video. But to answer the question, yes, it is possible and it is still intact, but it has to happen by tomorrow. The Qs and the markets overall need to have a green date by tomorrow to keep the cup and handle formation alive. If we have another red day, specifically a big one, then the cup and handle formation will break and go out of the window. Let's move on to the Dixie, the dollar index, from a 15 minutes perspective. And here is the mystery, of course, because you would assume that having a big red day in the market would correlate with a surge in the dollar index. We did not see that. We actually saw the dollar index declining today, breaking the 93.5 support, which was a very important level to keep and to hold for the Dixie here. So what do we make from this action? Somebody's lying here. Somebody, when I say somebody, I'm talking about charts, of course, making a false move. Either the market is right and we haven't seen panic yet, and that will come later, perhaps by tomorrow, and you will see the dollar index surging very high. Or is it the other way around, where the dollar index is telling the truth, yet the market is faking it, and the market is creating a bear trap, and you will see the market surging and bouncing higher tomorrow, and you'll see a sustained decline in the dollar index. This is the battle, and this is the mystery here. When you have these divergences, there is no clear answer, but we are trying to dig and investigate further. So let's do that. Moving on to the gold chart from a 15 minutes perspective. Right away as the trading opened here in the US, you saw gold futures declining and sliding along with the indices. So let's write that down so we can solve this mystery, or try and attempt to solve it by the conclusion of this video. Here's another piece of the puzzle. You saw the VIX popping higher today, and this time around, from a daily perspective, we did not see the VIX popping and then giving the gains away like we see usually. So what's going on here? And when you switch to a weekly chart, we talked about that this week will be the VIX's week to either put up or shut up. The VIX needs to break higher from the bull flag formation. We saw that happen today, but we still have 4 more days to go for the week to close. But it is an important indicator here for more volatility or more downside for the market. We'll add that to the pieces of the puzzle. Here's another piece. Moving on to treasuries now. The bull case, as we discussed yesterday, is an ABC pattern, meaning that treasury yields will pop higher, and that would mean a recovery for the market and a decline for the dollar index, etc. But we also have a bearish case now for the TNX. And the bear case says that we made a lower low today, and we're not making an ABC pattern here. All we're doing is we're rolling over, and you will see treasury yields declining from this point on. So tomorrow is very pivotal. You have to watch the TNX, the treasury yields. If we pop higher, then you know that the bullish case is right and we're heading to an ABC pattern. And that could be very good news for the market, indicating that a stimulus deal is very likely. Vice versa, if you wake up and you see treasury yields trading in the red, that would indicate that the bear case is taking over here, and it is a matter of time before panic hits the market. You see the dollar index correcting the false move from today, popping higher, and the market sliding lower. And now let's cover some important charts for individual names. How about Apple? Here's a 15 minutes chart. Right away you see the importance of the 120 level holding as support, or resistance rather, in the morning, and then we continued to slide right away. It was a flush down for Apple here, and we did break the 117 support, and I told you yesterday that the 117 support is a soft one and easy to break. We do have hard support at 113 and 106. These two should hold, and if they don't, you know what's going to happen. Next, how about a 1 hour chart so we can look at that clearly. You see the 113 and 106. They're supposed to be very solid support for Apple. Now what happens if you wake up and Apple is popping higher? The 117 becomes the first resistance. It will be a soft resistance. The hard resistance is at 120. Very simple here. And just by that understanding, you can make a lot of money trading Apple in daily trades. How about a daily chart of Apple? Not looking good here. No cup and handle anywhere to be seen here. And right away you see that we closed below the gap of 117 that we were supposed to catch support from. You can't sugarcoat it here. It is bad. What's going on with Tesla? Right away you see the numbers that I picked yesterday holding very, very good, and they're very accurate. You saw the level of 434 acting as support. And then we saw resistance at the 438.5 level, just like I illustrated yesterday. What happens after we slid down? Well, now the 434 level that was support before becomes resistance. And you see that clearly on the chart that Tesla struggled to break above 434 once it broke below it. And now we have to look to the southern destination for further support. We do have the same level we identified yesterday of 425.30, and you better hope, if you're a Tesla bull, that this level would hold, because if it doesn't, then it will look really, really bad for Tesla, specifically given the fact that we have upcoming earnings that could disappoint Tesla shareholders. Now, let's talk about the last chart that we have today, DraftKings. Here is a tweet I released about DraftKings saying that now it is worth it to buy calls on DraftKings. And right away, you saw DraftKings outperforming today. And I said that because we've reached very close to the support level that I had in mind of 41.50. DraftKings didn't reach all the way there, but it stopped at around 41.70. That was close enough, and when I saw a rebound, I decided to buy calls. Now the goal here, if things work out, the resistance is at 48.50, which will mean big gains for DraftKings. But keep in mind that we're seeing weakness in the market, and we talked about the Robinhood margin calls coming very soon. Guess which name is held widely by the Robinhood crowd? DraftKings. So if we see weakness in the market and further margin calls, the bounce in DraftKings will be delayed and you will see further downside in the name here. But from a technical perspective alone, the chart is a buy right now. We saw a reversal from the 41.50 level, and DraftKings should trade higher from this point on. Now, given the fact that we're seeing declines in the market, how do you do an option trade here with minimizing your risk? Number one, you buy the 45 calls expiring this week and you sell the 50 on top of it. So you're limiting yourself to $5 gains from the trade. Another way you could do it is to buy the 50 calls expiring next week or the week after, and then sell the 50 calls expiring this week, making it a calendar call. The point here is to reduce your risk and to minimize your entry bet as much as possible. And now let's move on to conclude this video. Right away, you're seeing that the donkey mentality of buy first, ask questions later doesn't work so well. When you assume that we're going to have a stimulus deal with no facts whatsoever, and you stampede to buy stocks, and then the thinking comes later. Well, today we saw the thinking that we're getting very, very close to elections here, and we don't have a stimulus deal yet. Now, at the end of the day, we might have a deal tomorrow, who knows? But it goes to illustrate that the donkey mentality of buying first, asking questions later is a no-good strategy. Furthermore, the market went ahead of itself, not just assuming the stimulus, but assuming good corporate earnings. We know that earnings season just started last week. Now, what happens if we don't have stimulus and earnings disappoint? And on top of that, we have elections volatility back in. You're going to have a triple whammy here against the market. Add to that the tsunami of margin calls, and you have a very bad formula for the market here. So if you're a bull, you better hope and pray that we have a stimulus deal tomorrow. But even that, and you've heard a lot of this narrative today in the media, talking about sell the news, even if we have a stimulus deal. So the risk here is clearly to the downside, and you have to buy some sort of protection here, whether it's buying the VIX or the inverse index or put options in the names that you already own. You gotta have some sort of a protection strategy here. And the last reminder we have here before I log off is earnings schedule. As you can see right in front of you in the screen, we do have P&J in the morning along with Lockheed Martin, and then we do have Texas Instrument, Netflix, and Snapchat after the bell. We will discuss and cover these earnings when we receive them. Also, I posted this slide in my Twitter account, but I forgot to add Las Vegas Sands. Las Vegas Sands is reporting earnings on Wednesday, so I managed to add that in this slide. So make sure you update the information that you have. That's all I got for you for today. So thank you for watching. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.